Okay, let's jump right into this explainer and diagnose a truly frustrating reality that plagues even the most analytical traders out there. We're going to break down the complex and sometimes chaotic interplay between higher and lower timeframes, and why mastering this strict hierarchy is absolutely crucial for institutional-grade trading. So consider this paradox for a second. Why do so many traders successfully do the hard work, they actually nail the daily directional bias, yet they still manage to hit their stop loss and lose money? You get the macro direction perfectly right, but your execution completely falls apart. It's a super common trap, and we need to understand exactly why it happens. Well, here is the answer. It's market noise. Retail traders frequently misdiagnose a temporary lower timeframe retracement as a full-blown macro reversal. Picture this, right? Your daily chart is clearly bearish. The 4-hour confirms it, but suddenly, boom, a sharp, aggressive bullish candle prints on the 5-minute chart. Panic sets in, you abandon your thesis, and you start buying into what you think is a new bullish narrative. Honestly, it's one of the most expensive mistakes you can make. Today, we are stripping away that retail fluff. We'll quickly run through the hierarchy of timeframes, how to actually lock in your directional bias, how to avoid that lower timeframe trap, lay out a rigid execution framework, and finally, put the whole shebang into practice. Let's kick things off with our first section, the hierarchy of timeframes, specifically looking at parent-to-child price swings. As the Inner Circle trader teaches, the market operates on a very strict hierarchy. Think of the larger timeframes as the parent laying down the law. Why? Because the daily chart holds the massive bulk of institutional volume and algorithmic programming. A 1-minute chart literally cannot overpower billions of dollars in institutional order flow. It merely navigates within it. The lower timeframes are just the subordinate child. This institutional framework maps out exactly how we should treat our charts. Your weekly chart provides your macro objective. The daily chart, that dictates your true directional bias. Moving down, the 4-hour and 1-hour give you context and confirmation. Then you have your 15-minute chart acting as your bellwether for setups, and the lowest timeframes, the 5-minute, 2-minute, or 1-minute, those are strictly for pulling the trigger. Direction comes from above, execution comes from below. The moment you reverse that flow, you are trading against the algorithm. Now, before we even consider dropping to lower timeframes for an entry, we have to determine our directional bias. Where exactly is the algorithm reaching? Bias isn't about guessing, and it's certainly not about relying on lagging retail indicators. It's about systematically locating the liquidity pools that act as giant magnets for price delivery. The market is constantly seeking to sweep buy-side liquidity above old highs, grab sell-side liquidity below old lows, or rebalance inefficiencies like fair value gaps. Finding these exact targets on the higher time frame is what actually gives you your directional bias. Which brings us to this core philosophy. This is the singular, most important question you must answer before sitting in front of your screens. What is the current market narrative, and what is it likely to be doing right now? If you can't confidently answer what the daily narrative is and where it's reaching, you have absolutely zero business dropping down to a 5-minute chart looking for an entry. Narrative first, always. That leads us right into the lower timeframe trap. Let's look at the crucial difference between a retracement and a reversal. This is where so many traders get chopped up. They confuse a simple algorithmic retracement for a total structural reversal. Think of a retracement like a speed bump. It's a temporary move against the parent trend just to pick up liquidity or reprice, but the macro objective hasn't changed at all. A reversal, on the other hand, is a massive U-turn. It requires a significant structural shift that completely invalidates the higher timeframe narrative. So when you see aggressive green candles on a 15-minute chart during a daily bearish trend, it almost never means the market has turned bullish. It just means the algorithm is reloading to go lower. It's engineering a stop hunt, grabbing premium pricing, or filling a higher timeframe fair value gap. Smart money is actively creating a highly advantageous shorting opportunity, while retail is getting totally trapped buying a fake out. To survive this constant psychological trap, we need a professional execution framework, a rigid decision tree to keep us grounded. Think of this as your firewall against retail impulsivity. You absolutely cannot look at step 4 until steps 1 through 3 are locked in. Define your daily bias first, confirm it on the 4-hour, locate your specific liquidity target, and only then do you allow yourself to drop to a lower time frame to execute. Following this rigid order is completely non-negotiable. Once that higher time frame target or premium level is hit, we wait for our signature, the market structure shift. We want to see energetic displacement, a sudden, deliberate move on the lower time frame that proves the subordinate child chart is finally back in sync with the parent time frame's objective. It's basically the algorithm confirming, okay, I've secured my liquidity and I'm fully ready to move in your direction. All right, let's put it all into practice and see how we navigate the 15-minute bellwether chart on a day-to-day basis. This timeline represents the true life cycle of an institutional-grade trade. Phase 1, get your bearings and establish your bias on the daily chart. Phase 2, map your specific targets on the 4-hour or 1-hour. Phase 3, and this is where most people lose their patience, but you won't, wait for the smaller timeframes to fall into subordination via a market structure shift. And finally, Phase 4, when the alignment is perfect, you strike with absolute precision inside a lower timeframe fair value gap. I really want you to anchor this exact question in your mind every single time you feel the urge to click a button during a volatile session. Is the lower timeframe helping me enter, or is it distracting me? If your daily chart says sell, but your 5-minute chart looks like an aggressive buy, take a breath. The lower timeframe does not create direction. It only provides an entry into the pre-established higher timeframe trend. Because at the end of the day, the best traders do not follow the loudest timeframe, they follow the highest timeframe. Algorithmic order flow is dictated strictly from the top down, so master the daily narrative and let the execution charts come to you. Before you take your next trade, ask yourself, are you executing in harmony with the algorithm's true destination, or are you just becoming liquidity for someone else who is?